Good afternoon, ladies and gentlemen. My name is Chin Kylie, your host from the Energy Market Authority of Singapore. Thank you for joining us at our SIEW Energy Insights Webinar. We bring you the latest perspectives on key issues facing the energy sector in the run-up to the Singapore International Energy Week, or SIEW for short. SIEW 2020 will feature a hybrid format which comprises on-site events combined with live streaming for attendees who are unable to join us in person. Today's webinar, Hydrogen and LNG in Energy Transition, is held in partnership with S&P Global Platts, organizer of SIEW partner event, LNG and Hydrogen Gas Market Asia. To post a question, please use the Q&A tool. Let us know your name, organization, and if the question is directed to any of the speakers. Before we begin, let's take a look at the results from our poll. Most of our attendees are from Asia, and the majority of them are from the oil and gas industry. We have also triggered another poll, and the results will be shown during the Q&A session. It is my pleasure to now invite Mr. Jean-Baptiste Dubreuil, Senior Gas Analyst from this International Energy Agency, who will share on global gas and LNG short-term market developments and medium-term outlook. Mr. Dubreuil, please.
Thank you very much. Good afternoon, everyone. My name is Jean-Baptiste Dubreuil. I work for the International Energy Agency and I lead the natural gas medium-term analysis team. It's my pleasure to be with you this afternoon to share some of our latest insights in terms of global gas and LNG developments to the short to medium term. Next, please. So we have seen in the recent years, after 2 years of growth above 2% in 16-17 and remarkable 5% increase in 18 in global gas demand, a slowdown last year to what was the average of the decade, below 2% in 2019. And this year, of course, is rather unprecedented at all levels with the COVID-19 crisis and the economic slowdown will result from it. And our expectation is that we will expect a 4% drop in global gas consumption, which is an unprecedented contraction in global gas demand we've ever seen ever since gas became a global commodity. Next, please. Thank you. It is worth to be mentioned, however, that the gas demand was already in decline in most major markets this year before the outbreak of the COVID-19 crisis. As you can see on this chart, most markets in the Northern Hemisphere were impacted by the particularly mild winter that we have seen this year. It is the case for Europe and the United States. You can see that January was in between -5, -10% below what was the average consumption of last year. However, the situation is a bit different in two markets. So Europe, the dark blue curve on the chart, recovered partially until March and then was strongly affected by the impact of the nationwide lockdowns, which were enacted to curb the development of the COVID-19 pandemic, which led to another fall in consumption. At the end of H1, the European consumption stands roughly 7% below last year. Whereas in the United States, we see that consumption continues to recover, especially thanks to very low gas prices for power generation, keeps on displacing coal in power generation. As of end of June, US gas consumption stands roughly 2% below last year. The situation is, if we look at Asia, the situation is different. Looking at the different main markets, mature markets such as China, Japan, which remains the largest LNG importer as of today, you see that there's a structural decline since the beginning of the year, with the impact of the economic slowdown, also the progressive return of nuclear capacity in Japanese power mix. China, which was the first market impacted by the COVID crisis in February, has seen a rebound since the month of March, but is still very sluggish growth compared to the two-digit growth that we have seen in the past years. And another case for more emerging markets, we can take the case of India, which is the yellow curve on the chart. You see that after a strong bump in the first month, which was facilitated by the very cheap price of LNG on global markets, the consumption growth collapsed with the enactment of a nationwide lockdown end of March. You see that as of end of May, the consumption is more or less aligned with last year. Next slide, please. On the supply side, the picture is slightly different. So you have on this chart the two main natural gas producers on the left-hand side, the United States and Russia. You see that the picture is a bit different if we look at those two major producers. See, in the United States, production so far in 2020, the red curve has remained quite resilient. And until end of May, it was flat around 80 billion cubic meters per month, and started to decline in the month of June and went below last year. But before the month of June, the United States production was still above the previous year. In the case of Russia, you can see the impact is much more severe because of lower consumption on the domestic market, also lower imports from Europe. At the end of H1, Russian production was 10% below last year. In terms of trade, you see that global LNG trade in the middle of the slide was also showing some resilience until end of May, thanks to the support from the European market, which has played a strong role as a balancing market, keep on absorbing the surplus volumes from the global energy supply. But those volumes from Europe collapsed in the month of June, minus 40% month on month, which led to the drop that you can see on the slide. When we look at Europe more in detail, you see that the overall European gas imports have declined, but this hides, again, a very strong support from LNG imports, which compensate a sharp decline from traditional pipeline imports from Russia and from the North African markets. Next, please. Thank you. So the conjunction of this lower demand and still resilient supply is quite visible on prices. As you can see on this chart, all major benchmark prices have seen a sharp decline since the beginning of this year, especially in Europe. The TTF price index since the beginning of the year. We can also see that the Asian LNG spot price assessment is also close to minus 60% compared to the beginning of this year. Next one, please. Next slide, please. Thank you. So our anticipation for this year, again, we do think that we will see the largest contraction in natural gas demand ever recorded, minus 4%, about 150 billion cubic meters. That's more than the consumption of countries such as Japan. In terms of how this contraction is developed, we can see that on those pie charts on the left-hand side, you have the geographical breakdown. You see that about 75% of this decline is likely to happen in mature markets in Europe, in North America, Eurasia. First, because those markets were impacted by the extremely mild temperatures this last winter, and second, because the role of natural gas in power generation is particularly at stake, especially in Europe, where it is caught in between declining power generation needs and the increase of renewables. You see that other regions, which are more fast developing regions, especially in the Asia Pacific and Middle East, are less impacted. We do assume that it will account for 25% of the overall decline this year. In terms of sectors, it is again power generation accounting for half of this decline. Residential and commercial was mainly impacted by the mild temperature the last winter, and industry, we do expect that it will account for about 20% of the overall decline. Next slide, please. Next one, please. Thank you. So again, looking at the contraction this year, you can see on the left-hand side chart that we do assume that most of this decline is expected to come from the mature markets, Eurasia, Europe, North America, and OECD Asia. However, the story is we do assume that next year we'll see a global rebound in gas consumption, and we will more or less return in 21 to the global consumption figures that we have seen last year. However, the story is not of a return to business as usual. It's not like what happened 10 years ago with the great financial crisis 2008, where we had a 2% contraction in gas demand in 2009 and a 6% expansion in 2010. Here, we do assume that most of the recovery will happen in those mature markets because of a progressive return of power consumption and also return to normal weather conditions for heating purposes. However, the dynamic of growth will be impacted, and you can see that in the next 5 years, we do assume 2021 to 2025 that Asia Pacific will be the leading source of additional growth. However, this growth is not as abundant as we anticipated earlier this year. You can see on the right-hand side chart, we went from a pre-COVID-19 anticipation for the next 5 years of an annual average growth of close to 1.9% to 1.5% currently, which means that the recovery will not be complete, and that there will be some long-lasting impacts of this current crisis on global gas and LNG markets, resulting in about 75 BCM per year of lost growth, which is more or less the global increase that we have experienced last year. Next one, please. One of the signs of this lower growth is to be seen in the global LNG trade. We do anticipate that this lower growth in demand will coincide with the major expansion in terms of supply, with a batch of new projects being sanctioned in the United States, in Africa, in Russia, and in Asia in the recent years, which will come online in the next 3 to 4 years. As you can see on this chart, the bar charts shows the liquefaction capacity, so the capacity to export LNG, and the green bar shows the LNG exports, so the actual utilization rate, which is derived from that. The black curve shows that we're not likely to see a tight market in the next 5 years, which casts a strong shadow on future investment capability in the LNG sector, and therefore in the longer term security of supply for global gas and LNG. Next one, please. So to wrap that up, we have we are currently experiencing the largest contraction in gas demand ever recorded, about 4% from our latest estimates. We do assume that most of this decline will occur in mature markets, especially in the Northern Hemisphere, which have gone through a very mild winter over the last season, combined with the impact of lockdowns and sluggish economic recovery for the next month and year. The losses, those 150 BCM of lost demand, are to be recovered in the next 2 years, but it doesn't mean, again, that we are going back to a business as usual return to structural growth, and that this growth rate is expected to be tamed compared with what we have seen in the past, which will have impacts in terms of market tension, in terms of prices, in terms also of investment decision for the future, which will in turn have some repercussions in the longer term future and the capability of the market to deliver both supply, flexibility of supply and security of supply in those fast growing and price sensitive markets in Asia, in the Middle East, in Africa, and in Latin America. The IEA, of course, is closely monitoring the situation, and we've been with all the stakeholders engaging discussions with the governments and the industry ever since the beginning of the crisis, and we keep on closely monitoring the situation, and we'll update this market view and short-term forecast in the fall with the next publication, which now becomes a quarterly publication. Thank you very much for your attention.
Thank you, Mr. Dubreuil. For those who would like to pose a question to our speakers, please use the Q&A tool. Let us know your name, organization, and if the question is directed to any of our speakers. It is my pleasure to now invite Mr. Kenneth Fu, Managing Editor, Asia LNG S&P Global Platts, who will share on LNG market in 2020, fundamental changes and pricing shifts. Mr. Fu, please.
Hi, everyone. I'm Kenneth Fu, the Managing Editor for APAC LNG and Platts. Before I start, I just want to say a big thank you to the SIEW team at EMA for organizing this webinar. And it's a real pleasure to start in these challenging times. My presentation will look at some of the changes and pricing sort of disruptions in the LNG market this year, focusing more on the spot market and shorter term trading trends. Next slide, please. First, some disclaimers. Next slide. Now, just a quick price chart to start off. Spot LNG prices in Northeast Asia, the JKM is currently languishing at record lows of about $2 on the back of demand destruction in major importing locations due to the pandemic. And you also have abundant supply disruptions following the deferments and cancellations of spot and term cargo. So it's really, if you look at this chart, a cocktail of bearish factors that harken back to 2018 and 2019, starting from when a warm winter meant that inventory levels at Northeast Asian end users were already high before COVID-19 actually hit this year. Now, with the expectations that we could be relatively well supplied this year, along with already high stocks across Europe and in Asia, it might be difficult to picture very significant incremental demand in Asia to meet the growth in supply. And if you look at prices this year, even with at certain points netbacks from the US Gulf Coast into Asia remaining closed, the production volumes within the Asia Pacific itself still appear to overwhelm that of consumption and demand in Asia. So we could see low spot prices in Northeast Asia guide supplies elsewhere, such as India and Europe itself. Next slide, please. Now, coronavirus and warm temperatures definitely had a huge impact on LNG demand over the last couple of months. But we also did see some reshuffle of trade volumes, which saw Chinese demand even fell below the last 2-year levels in 2018 levels. But over January and February, we did see South Korea and India both emerge as pretty strong demand centers, despite the lack of support from the weather, which in turn aided regional growth. This opportunistic buying by the two countries showcased this long-sought flexibility in the market when the historical lows of LNG prices were hit. But the chart also shows that the gradual recovery of locations like China and Taiwan, where demand is starting to come back around, and it's even come around to levels that exceeded 2019 levels, especially in the last 2 months or so. Next slide, please. Now, looking at the supply side, what we can see is that the surge in supply over the last 2 years or so can be largely attributed to increased exports from the US, Australia, Russia, and Qatar. Australia definitely provided the biggest supply growth before the US staged an exponential growth of its own. And of course, the US had initially been expected to become the world's top LNG exporter in the mid-2020s, but this prospect looks a little less uncertain at the moment. What we also saw within the first couple of months of the year is that LNG producers continue to maintain in the first quarter of the year as oil-linked prices remain high. The big fall you see in US exports at the bottom right of the chart is because exporters have been cutting output from the US, with off-takers cancelling their volumes due to negative netbacks relative to production costs. Now, in the longer term, what we can expect is that ultra-low gas and oil prices, coupled with demand destruction from COVID-19, may even slow liquefaction build-up further, with limited capacity increase, I think, anticipated within the foreseeable future. Next slide. Now, the LNG market witnessed quite a dramatic decoupling of oil-linked term LNG price and spot LNG price in 2019 and 2020, as oversupply definitely pushed down LNG prices. However, due to relatively resilient oil price in 2019, we see that oil-linked LNG term prices held strong with in the $8 to $10 price band. But the great crash in oil prices in March actually created some curious situations where oil-linked LNG term contract price fell very close to the spot LNG price, and even at a massive discount to the Henry Hub linked term price. Henry Hub, of course, is the US gas benchmark. And we even saw weak spot price in Asia cross with European gas prices several times this year. I think it also outlines the importance of a market price, LNG price against an LNG benchmark, one that fully reflects LNG fundamentals and in which is affected by minimum noise from other markets, as well as being neutral to both buyers and sellers. So going forward, I think both the market and Platts analytics see JKM prices to increase, perhaps averaging slightly above $4 in 2021 next year. And this is significantly higher than what we have right now, around the $2 mark. Yet this price level still may discourage some market participants who expect even more lucrative margins. Next slide, please. Just to compare the volatility among all the gas and gas and LNG benchmarks, I think this slide could help to dispel the notion that comparatively speaking, an LNG price is a lot more volatile than your European gas hub price or your crude oil prices. Of course, crude oil prices witnessed significant volatility this year due to the big crash in Q1 and a subsequent rebound. And we also saw quite a bit of volatility for European gas hub prices, TTF and MBP late last year. So if you look at over the course of the last 2 years, LNG prices represented by the JKM actually holds or compares pretty well against the other benchmarks itself. Next slide, please. This slide just shows some of the contracts that are being linked to spot LNG prices in the last several months or so, starting this year. JKM is, of course, the benchmark for spot LNG within the JKTC or Northeast Asia region, but West Indian market is fast becoming a well-adopted and widely referenced price, and it's currently used to price downstream domestic gas within India itself. Next slide, please. And I guess one very key development within the LNG market itself is the growth in the derivative space, which witnessed, some would say, the fastest growth across any product, any sector, any segment of the LNG market. Volume surpassed 100 million tons in 2019, or about a third of the physical market itself. Of course, a more liquid paper market tends to encourage more physical spot trade as traders feel more comfortable taking physical positions that are not hedged against an associated commodity, but against LNG itself. So just looking at the chart, the volumes we are talking about here are only those that are cleared through the exchanges, through ICE and CME. So they do exclude volumes that are traded bilaterally. Open interest has also surged consistently. Clip size is fairly small at 10,000 MMBTU, so the trading quantity can be quite flexible as well. Next slide. Now we think that the growth of the Platts market on close remains a game changer for the market by using a high quality and verifiable information in the form of bids, offers, and trades to form the basis of the JKM LNG assessment on a daily basis. And since it launched, there has been more than 2,500 bids, offers, and trades with over 60 trades agreed on during the process so far. And the next slide shows the system in which it's taking place on. The Platts e-window has been widely adopted to support the MOC, and that's enabling market participants to communicate bids and offers and trades to Platts editors and the marketplace simultaneously. With that, I've come to the end of my presentation. I look forward to the panel discussion in a few minutes' time. Thank you.
Thank you, Mr. Fu. I would now like to invite Dr. Fiona Simon, Chief Executive Officer of the Australian Hydrogen Council, to share on the rise of the hydrogen economy. Dr. Simon, please.
Hello, thank you, Kylie. It's a pleasure to be here. So as said, my name is Fiona Simon. I'm the CEO of the Australian Hydrogen Council. The Australian Hydrogen Council is the peak body for the hydrogen industry, with members from across the hydrogen value chain in Australia. So we connect the emerging hydrogen industry and its stakeholders in building a secure, clean and resilient energy future based on hydrogen. So a key objective of the Australian Hydrogen Council is to accelerate the commercialisation of new hydrogen and fuel cell technologies for transportation, export, storage and stationary applications in Australia. We seek to do this by collaborating with all stakeholders in the hydrogen space. So we go to the next slide, please. So we started off as Hydrogen Mobility Australia, and it was formed in 2017. But in October last year, we changed the name to Australian Hydrogen Council, and that reflects the diversity of our growing membership and the broad hydrogen agenda. So we now have 44 members from across a range of industries and up and down the value chain. This slide shows you a number of the logos for the companies who have joined AHC, and we're pleased to say that people are continuing to join even in this environment with economic downturn. So next slide, please. I'll spend a bit of time on this slide and essentially just really wanting to tell the story about why hydrogen. hydrogen is unique in many respects, and it is useful to briefly outline why that is. So first of all, it's storable over time and transportable. So hydrogen can exist as a gas or a liquid, so it can be stored for long periods of time, and unlike batteries, not lose its energy value. So that's where hydrogen can play a really important role in balancing electricity grids. Hydrogen can be transported over long distances, whether that's by truck or ship or pipeline, and that helps communities maintain access to energy when needed. And of course, it's exportable as a result. Second, hydrogen is made and not found. So, and you can make it in different ways. So obviously there's the fossil fuel version and there's the green version, and it's green hydrogen that presents the longer term opportunity. And the basic technology isn't new. Although enhancements and new ways to produce hydrogen do continue to be developed, we've known how to make hydrogen through, say, steam methane reforming and certainly electrolysis for some time. The technology is known. And the man-made element of hydrogen can also enhance the economic resilience of regions and countries like ours. It helps diversify the energy mix. It can be made locally. And I think that's a fundamental difference as we shift through the energy transition. It's shifting not only from fossil fuels to those renewable sources, it's the opportunity to make it and not rely on particular geographies, for example, and geologies. Third, hydrogen is versatile, and so it can be converted for different uses across energy, transport, industrial processes. And it connects these sectors and it creates efficiencies because it can be moved around for different purposes as needed. And electricity and hydrogen together can provide the backbone for future energy production and use. And it does so in a way that does support economic resilience. So, so far, so good. It does lead to the question, why aren't we living in the hydrogen society already? And as you no doubt would be aware, it's because hydrogen production, transport and consumption do require infrastructure. We need the infrastructure to make it, to move it and to use it in a range of ways. And that infrastructure hasn't been created to date because we already had petrol, diesel, natural gas and coal to meet our energy needs. So there hasn't previously been a real incentive to look at hydrogen seriously, at least not in any long-term way. But obviously this is changing. We are seeing a move across the globe toward a low carbon future, and countries are starting to ban internal combustion engines, they're pricing carbon and they're setting ambitious green targets. So this means that the cost benefit analysis of hydrogen is shifting relative to the incumbent forms of energy because those incumbent forms are becoming increasingly untenable. So hydrogen starts to become the obvious answer. It becomes a source of public benefit as it helps us transition to the inevitable new economy. Of course, we're not there yet. The huge potential for hydrogen to decarbonise the globe requires infrastructure, and that in turn requires investment. It's useful to look at some of the figures that have been published to date. The Global Hydrogen Council's report, Path to Hydrogen Competitiveness, estimates that $70 billion of investment in hydrogen is required across the world by 2030 to meaningfully activate the global hydrogen economy. And while that may seem sizable, $70 billion by 2030, the Hydrogen Council report does note that this accounts for less than 5% of the annual global spending on energy. In comparison, support provided to renewables in Germany totaled roughly $30 billion in 2019. Analysis from Bloomberg New Energy Finance's Hydrogen Economy Outlook report does then go further, estimating that $150 billion will be needed globally until 2030 to bridge the cost gap between hydrogen and the cheapest fossil fuels, not just the cheapest low carbon alternative. Post-2030, BNEF, so Bloomberg New Energy Finance, proposes that policy measures such as carbon signals, rather than a pure funding approach, will be necessary to drive the further adoption of hydrogen. There's evidence, and we have the evidence within Australia, as well as sort of global studies, that public investments and policies to fill the gap can unlock 3 to 4 times their value from the private sector. So that's interesting, and at this stage that we're using those numbers within our own estimates of how much government investment would then draw through from the private sector. We've been really pleased to see recent announcements from Germany and the EU that recognise the scope of the task with hydrogen. For example, Germany recently launched its national hydrogen strategy to ramp up the German hydrogen supply chain. And that includes an investment of €9 billion, split into €7 billion for the market ramp up of hydrogen technologies in Germany and a further €2 billion for international partnerships. Move to the next slide, please. Thank you. So what's next in our region? Well, we need to get on with building scale and getting the costs down. And there are different ways to think about this, but one thing is clear, we need to establish the market. So the Australian Hydrogen Council focuses on policy to establish the demand to then bring on the supply. An export market potential is one type of demand, and it's driven so much of the Australian interest to date. However, domestic demand is needed if we're to get to the scale required to export, and there's obviously arguments for domestic anyway. So domestic demand could be through using fuel cells to drive cars, buses, trucks, ships, trains. It might be through gradually replacing natural gas for heating and cooking with hydrogen, so blending hydrogen into the natural gas network. There's industrial and chemical processes. There's talk about green steel. There's energy storage as well to give us security of energy supply. And these things are already happening in Australia, albeit at a smaller scale than what's required. We're looking at pilots and demonstrations. In Australia, we do have significant government support, and that has continued to increase, which is fantastic. Along with the federal government, all 8 state and territory governments have committed to a national hydrogen strategy, and that was released in November last year. The National Hydrogen Strategy sets out actions for the development of a clean, innovative, safe and competitive hydrogen industry. And there's 57 joint actions, and they're themed around 7 areas. There's national coordination, developing production capacity, responsive regulation, international engagement, innovation and R&D, skills and workforce, and community confidence. And the range of actions consider hydrogen in relation to all the uses, so export, transport, industrial use, gas networks, electricity systems, and there's cross-cutting issues such as safety and skills and environmental impacts. We've also been really pleased to see the states and territories of Australia have also been developing their own approaches to hydrogen, but consistent with the National Hydrogen Strategy. And they're all either working on or have released hydrogen strategies and action plans that demonstrate their particular priorities. So the slide up there shows several of those publications. If you go to our website, there are links to them all, as well as a range of other material if you're interested about the Australian hydrogen market and our members. So the Australian Hydrogen Council is very much part of the overall picture to work with governments and try to coordinate the work across the country, and there is significant goodwill. So move to the next slide, please. So before I finish up, there are lessons that we've learned from our COVID-19 experience that we could apply to the development of renewable and clean energy, such as hydrogen. I mean, first of all, we've seen the drops in pollution across the world, and this shows communities what clean air looks and smells like. And obviously, the effects of the pandemic on the world's economy are catastrophic, and we need to get industries back up. In doing this, though, we've got a bit of a clearer vision, both actually and figuratively, of the public benefit that we should be working towards as we manage the energy transition. Second, the pandemic and the recent oil price fluctuations have shown that Australia and other countries in our region need to value energy diversity in the interest of economic security. Local hydrogen production can provide high volumes of energy to industry, cities and homes. Importantly, it can also create local jobs. It can bring new design and manufacturing opportunities, looking at, say, fuel cell technologies for automotive, aviation and marine industries. So to wrap up, we're at a defining point in history. Countries like Australia and Singapore can choose to use this opportunity to decarbonise our energy use through building the infrastructure for hydrogen production and use. We have the chance to boost our country's resilience to economic and environmental shocks using clean, green, locally produced hydrogen in the energy mix. So we're working hard with members in Australia and with our partners across the region, and today's session continues that important work. So thank you very much for having me. It's been a pleasure.
Thank you, Dr. Simon. We would now like to welcome back Mr. Dubreuil and Mr. Fu for the panel discussion. I would also like to introduce Mr. Randolph Bell, Director of the Global Energy Centre Atlantic Council, who is also joining the panel discussion. Moderating today's session is Mr. Sandeep Mahawar, Senior Vice President, Commercial and Business Development, Singapore LNG Corporation. For those who would like to pose a question to our speakers, please use the Q&A tool. Let us know your name, organization, and if the question is directed to any of the speakers. I will now hand over to Mr. Mahawar.
Kylie, thank you very much. A very good afternoon to my panelists. And I wanted to also remind the participants to put in your questions as I go through the moderation. I'd just like to kick off by looking at the polling results. That were some questions that were asked earlier. Can we have the results, please? First one, when will hydrogen become an abundant and economic fuel of choice? I think we are seeing about a majority of respondents saying 10 to 20 years. And I think there's an equal weightage between 5 to 10 years and 20 to 30 years, quite mixed. The next one, will hydrogen be a substitute or complement to gas in the long term? And I think the majority believe that this will be complementary to gas. That's very good. Okay, how many LNG project FIDs do you expect in 2021 next year? Seems a bit pessimistic, and we are seeing majority of saying between 0 and 5, about 35% between 6 and 10. And very few, I think, believing that you'll have more than 11. The last question on the poll, will the current pandemic change attitudes towards choosing cleaner and or lower carbon fuels, such as LNG and hydrogen? I think a majority are saying that it will change attitudes, and about a quarter not very sure about that. So those are some of the polling results. Also for the panelists to take note. Thank you. Let me just start off with the questions and answers. We do have some questions coming in, and we have about 35 minutes for Q&A. Let me maybe start off with Randy. Randy, are you online? I can't see you, but are you there, Randy?
I'm here.
Okay, Randy, let me just give you the opportunity to take a minute to maybe introduce Atlantic Council and what you do. And then maybe I'll follow up with a question with you.
Great. So thanks so much for having me here. We are at the Atlantic Council big fans of SIEW, and hoping that we'll be able to travel to Singapore this year. We'll see if Americans are allowed to travel anywhere at the current moment. The Atlantic Council is a foreign policy think tank based in Washington, D.C., and our Global Energy Center focuses, of course, on the energy issues surrounding foreign and international affairs. So that we primarily look at security on the one hand and sustainability on the other. And we have a distinct policy focus. And so our work tends to look at, for instance, how do countries manage their energy security, what types of policies do they make to lower their carbon footprint, et cetera.
Thank you, Randy. A follow-up question, given the increasing level of choices of energy sources such as LNG, gas, and hydrogen, how is the global energy landscape evolving beyond the traditional reliance on coal and oil? And can you just talk a little bit about the key trends? Right.
So I see 4 or 5 key trends to talk about. And I think the most important thing from my perspective to think about right now in a COVID, or in the US, we're still distinctly in a COVID world. In some parts of the world, you're sort of past that point and in a post-COVID world, is to think about how policy will change the energy system. And so along those lines, you asked the question about coal and oil, and I think that those are 2 big changes. So first, I think it seems very likely that coal demand has peaked, and probably peaked before COVID, but there's policy that is driving that to probably continue to decline. And you just look at what Japan announced recently with the change in policy to stop the export of their coal power plant technology. And you'll also note that 3 EU countries have announced early closures of their coal plants just this year. And as our other panelists mentioned, LNG prices are so low that encourages more coal to gas switching. The other piece of your question on oil, I wouldn't want to say that oil demand has peaked, but that's a fair question to ask now. And I think that change has happened since earlier this year, where the question was, will oil demand peak? If it will, when will that happen? And every major analysis or projection said a different year, depending on the different policies. It was 2030, 2035, 2040. But there's a real question right now if oil demand has actually peaked already. Now, I know the IEA has said it has not peaked. Jean-Baptiste's boss has said it has not peaked. But Bernard Looney said, he's just not sure. And that policy is the real driver at this point. And there's a possibility, at least, of policy continuing to drive demand down for oil. And so that we could have seen in 2019 the peak of oil demand. I think that's probably not the case, but I think it's fair to ask now. And a couple of other key trends revolve around decarbonization. I think you're going to see continued policy pressure on fossil fuels, with the exception of gas with CCS, where I think you're starting to see a greater acceptance from the climate community that carbon capture is going to be an important technology as we look to decarbonize. And I think, as Fiona mentioned, there's a huge push for hydrogen right now. However, the possibility of moving to entirely green hydrogen in a timeline that is reasonable for our decarbonization goals is fairly unlikely. We've been running the numbers internally recently, and if, for instance, you'd like to move all of the current hydrogen that's produced in the world today, about 70 million tons per year, to green hydrogen, you need about 50%, depending on the efficiencies and how you think about capacity factor of variable renewables. But you need about 50% of the total installed renewables to date to produce all the hydrogen that's now produced through steam methane reforming as a green technology. If you want to replace, if you want to do switch of all the diesel demand in the world, and you think that hydrogen, one of the main potential uses of hydrogen is in heavy transport. So if you were to say all the diesel demand in the world will be to switch to hydrogen, you're talking about a fourfold increase in variable renewables installed just to produce all that through green hydrogen. So CCS is going to be is increasingly important and tied to gas. You're also going to see, and I think continue to see, a rise of corporate pressure on climate action. And so you see this through pushes for climate disclosure, and particularly through the conversation around ESG. I think Morgan Stanley's announcement yesterday that it will tally its financed greenhouse gas emissions is very important and is going to be an important ongoing trend. And I think you'll also note that ESG funds have been outperforming standard funds even during COVID. ESG is not a fad. However, I do think we're going to need to see more formalization of what ESG actually looks like. There are, of course, three buckets. There's the environment, social, and governance, and each fund makes its own choices about how to weight each of those three buckets. And so some environmentalist investors have been dismayed to find that within an ESG fund, you might find an ExxonMobil, because ExxonMobil scores very high on the social and the governance. On the other hand, I was looking at an ESG fund the other day, and it purposefully excludes nuclear power. And I am of the opinion that many are that you need nuclear if we're going to meet our environmental goals. So that question about what falls in the environment bucket, I think is still open to debate. And
okay,
then
Randy, yeah. Thank you for that. I'm going to stop you over there, and I will come back to you in a bit. I do want to cover some other questions as well, and thank you for that. We'll come back shortly. I wanted to ask the next question to Kenneth. There are questions coming in with regards to the expectation of US cargo cancellations going forward through to winter, as well as what is the short-term forecast on the LNG JKM price and demand?
I can't really answer the second part of the question directly because I don't. My team doesn't focus on the forecast itself. But if you look at the forward curve in the derivatives market, what you can see would be fourth quarter prices around the 360, 370 mark, and the first quarter 2021 prices around the 470 to 480 mark. So I think the winter average you would expect, as I mentioned earlier, we could start 2021 at just slightly above $4, but that's just looking at the financial derivatives market. With regards to US cargo cancellations, again, it's about the expectations of forward prices, and forward prices are inevitably affected on a seasonal basis. So if you look at the forward curve, the European gas hub prices and JKM prices would, as I mentioned earlier, witness a slight boost as we head into winter and as demand in Asia and demand in Europe grows due to lower temperatures. So what you might see would finally be more positive netbacks and thereby allowing off-takers a little bit of a margin to lift some of the cargoes. So if you look at the recent cargo off-takes for this particular off-take deadline, that definitely has seen an improvement compared to the last 3 or 4 months. And if the netbacks continue to be less disadvantageous, I'm not saying more advantageous, but less disadvantageous, then we could see that sort of more off-takes being kind of lifted and more cargoes being taken.
Thank you, Kenneth. Any plans for pricing of hydrogen going forward, especially green hydrogen?
Currently, the only set of price assessment series that we have for hydrogen is in Japan. We have developed sets in North America as well as in Europe because the market is a lot more advanced and has kind of taken a step further within the Atlantic region itself. But if there is demand for it, we definitely can consider both for blue hydrogen or green hydrogen.
Thank you, Kenneth. Fiona, question for you. Australia is a big exporter of LNG. Any plans for Australia to export green hydrogen? And if so, what would that be in terms of impact to the LNG export industry?
Thank you. Certainly, Australia sees itself as being one of the top 3 exporters of hydrogen by 2030. So that's something which is set out in the National Hydrogen Strategy. And as I said, there's links to that on our website. At this stage, though, it's not decided whether that would be green or whether that would be clean. And that's been left open for, I guess, the technology and the markets to determine over time. Certainly, so my membership covers entities that currently make hydrogen through steam methane reforming. It's those who want to make it in the future with carbon capture and storage, so blue hydrogen, and definitely includes those who are currently and certainly have ambitions to be major green hydrogen producers. I think there's general agreement that the future, and then I guess there's disagreement about when the future comes. There's agreement that the future is green, and many people are working on how to get there faster. So yes, Australia is going to be a major exporter. That's definitely the goal. We see ourselves as really being in a good position to do that. The degree to which that replaces LNG, I think, is something I probably couldn't comment on. It would be a matter of the shift over time and obviously what makes sense commercially.
Thank you, Fiona. I think we also had in the polling that a lot of people believe that hydrogen and gas or LNG will be complementary. So I've got a question over here for Jean, IEA. In IEA's assessment of the global fuel mix in the next 20 years, what are the key highlights that governments and businesses need to be aware of when shaping their growth strategies? Can you also talk about a little bit about the fuel mix in terms of where you see hydrogen in that fuel mix globally?
Sure, thanks. Well, the current COVID crisis impact is expected to lead global GDP contraction about 6%, according to the latest figures from various sources in 2020, with major impacts for the energy sector. We do assume that global investment in energy could shrink by 20% this year. And while some 3 million jobs in the energy sector are at risk, plus another 3 million in related sectors such as vehicles, buildings, or industries. The IEA released a couple of weeks ago a special report which outlines a sustainable recovery plan with recommendations to policymakers and business leaders to follow 3 main objectives for the recovery, which are boosting the economic growth, creating jobs, and building a more resilient and clean energy system. So the plan spans all the sectors and includes developing innovation in new technologies, essential technologies such as hydrogen. So I won't go through all the details of the recommendation. I strongly encourage those who are interested to go through the report's findings, which are available on our website. So on the hydrogen, I think that new sources of energy, including hydrogen, biomethane, or the low carbon energy sources, will further push competition with the fossil fuels, as we've already seen for renewable energies in more mature markets. And the resource potential is pretty huge. But as Fiona mentioned in her presentation, the development of those sources require supportive policy frameworks to properly recognize the value of avoided emissions and to improve the cost competitiveness of the new sources of energy.
Thank you, Jean. I'm going to go back to Randy. And Randy, this is probably quite a big question. And I'm going to challenge you to keep it tight and to the point with regards to the upcoming US general elections. And where do you see the US energy policy post-election, depending on who wins, and as well as the US sensing on climate change policy as well?
Right. So yes, a big question. If Trump wins, I think you will see a continued evolution of the U.S. on climate change. While President Trump has been opposed to acting on climate change previously, you'll note that he hasn't tweeted about climate change in over a year, and the Republican Party is making progress on a climate plan, and we expect to see something as a response to the Democrats in September. There's been a recognition by senior leadership in the Republican Party that they can't retake the House if they do not have some sort of climate plan, simply because the people who skew younger recognize that climate change is something that you need to act on in one way or another. You'll also note that folks from DOE over the past year have been much more comfortable talking about a low carbon future or exporting renewable technologies. So we'll see a continued evolution on climate action under a Trump plan, but it will not be nearly as dramatic if Biden wins. And I think what's important to say about Biden, if Biden wins, is that while he is adopting some of the best policies from the left of the Democratic Party, it's still a very pragmatic set of policies. There'll be major investments in infrastructure, in clean infrastructure, major investments along a range of technologies, but so far it has looked to be technology neutral. So not against CCS, not against nuclear. It looks to be, it will be probably harder to develop new oil and gas projects in the United States, but not impossible. And it'll be very unlikely to see an export ban like you've heard from some folks on the left in the United States. I think that foreign policy elements and staffers in the Biden campaign really recognize the foreign policy value of our oil and gas exports, and also recognize the value of, in particular, exporting gas to the developing world, where that allows for coal to gas switching.
Thank you, Randy. Question for Fiona again with regards to the use of hydrogen in shipping, and how is that going to displace basically LNG with IMO coming on already in 2020, and kind of the views that quite a number of ship owners want to move towards LNG?
I Well, at this stage, shipping is something which we haven't been engaged. We haven't been engaged in the detail on that with AHC. So all I could really say is that there appears to be a huge potential, but then there's also, but then the reality is we need to understand it more. So no, I'm not really in a position to answer that one, I'm afraid.
Okay, I've got quite a number of questions coming in on the cost of hydrogen and pricing for hydrogen, and one in particular asking, when do you see $2 per kilogram for green hydrogen?
Well, that's good. Certainly, we have a goal of H2 under 2 in Australia. That's a policy goal, and that's production of hydrogen at under $2 Australian is how we're viewing that. And we're doing work right now to decide, try to work out what is reality and what is an ambition, and how can we match that also with a national hydrogen strategy and the modelling that's gone into that. So I'll throw out 2030, but to be honest, we're still trying to work out what this would look like, what's practical. The ambition would be 2030, but that's what that is at this stage. It's an aspiration and an ambition.
Thank you, Fiona. Kenneth, question for you. The LNG supply chain is expensive, requires large investment. There are many project deferments, and you also saw the views of some of these FIDs being deferred. With hydrogen coming on stream and a lot of excitement coming in on hydrogen, how do you see that derailing the growth of LNG and the gas business going forward, and any other disruptions that you foresee?
Thanks, Sandeep. That's a really important question that I think a lot of people in LNG are asking themselves today, because in the current environment, LNG project owners definitely will find it very hard to move ahead with their plans as per schedule. And for companies that are addressing multiple investment priorities, delays could occur inevitably on new contracts that are scheduled to start later this decade, maybe in the 2023, 2024 to 2027 time frame. So that sort of delay does kind of introduce a potential a threat, or at least a possibility that a hydrogen economy could start to be a serious competitor to LNG, especially in terms of being a transport fuel. But what we need to remember is that hydrogen supply and distribution still face the same barriers as any nascent commodity, such as high production costs and complementary infrastructure requirements. And some countries could struggle to develop this market. And in these countries, LNG may also be needed. For example, in a country like India, in order to produce blue hydrogen, which is cheaper, more mature, and more scalable than green hydrogen to some extent, India might need to even import LNG as domestic gas is limited. So there is a bit of an interplay between these two commodities here. But we also need to bear in mind that LNG is already a very developed market with highly built infrastructure, a growing shipping fleet, and multi-year investment and supply contracts. So it's decades ahead of hydrogen, and it would take a lot of time as well as investment for hydrogen to actually kind of overtake LNG. And just to quickly answer the second part of your question about a potential disruption to LNG, that would of course be on trade conflicts, right? Because the ongoing US-China trade war definitely has raised concerns about the trade flow between both countries. So it definitely has been a big hit on shipping demand, on kind of LNG production investments. Although on the flip side, definitely it might serve as a development in terms of commoditization of LNG, as it creates a lot more trading opportunities and the need for shipping optionalities along the US-China trade route.
Thank you, Kenneth. Let's come back to IEA. Jean, can we talk a little bit about the role of the IEA with respect to climate change? And is the IEA basically fuel agnostic, or is the IEA promoting low carbon fuel sources as well?
Thanks. Yeah, the IEA is covering all the all the fuels and technologies, and we acknowledge, of course, and track the developments in terms of climate change and what could be the different impacts in terms of global CO2 emission, methane emissions, so on. Those we have developed several trackers which are available from our websites, and we do publish each year a global energy and CO2 emissions review of the past year. So we do assess, of course, the role of mitigating the impact of climate change in our long-term scenarios. In our World Energy Outlook, we have a sustainable development scenario which take into account the policy which are needed to make sure that the climate change impacts are curbed to a 1.5 degree target.
Thank you, Jean. Let me come back to Fiona on a question with regards to infrastructure required for hydrogen and how that differs from infrastructure that's already in place for LNG and other energy sources. Is it possible to mitigate the large investment gap by using infrastructure that's already built?
I would say so, and that's something where I think a number of my members would be hoping so, that there are sort of the natural capabilities there. I don't think we're in a position, well, I'm not in a position to go into the detail about what that might look like. I think we need to make sure that a whole range of the differences between hydrogen and the fuels it might be replacing through that infrastructure could be significant enough to require quite an overhaul, depending on what infrastructure we're actually talking about. Obviously, hydrogen has different physical characteristics, well, it has different physical capabilities as well to that which it will be replacing. And you'd need to be sure about safety aspects that are covered off. There is going to be a difference in how different materials cope with hydrogen versus how those materials cope with natural gas and LNG. So yes, you'd want to be able to repurpose the infrastructure. The question is, what does that mean? And that's probably a very large question, and it's one that we're still trying to work the answers out on that one.
Thank you, Fiona. Let me ask Randy a question with regards to hydrogen. I mean, hydrogen seems to be very colorful. Everyone has, blue and green. And what would you say with regards to the growth of the hydrogen economy? And do we all need green hydrogen? Can we talk about blue hydrogen, Randy?
Yeah, as Fiona said, there is a big push for green hydrogen, but I do think if you want the volumes of hydrogen to actually have a robust hydrogen economy, you need to be open to blue hydrogen. Simply as I was referring to earlier, the math gets very, very hard if you want to have a significant volume of hydrogen produced by renewables. And as you're, again, if you're just trying to replace all of the current hydrogen, 70 million tons a year or so, with renewables, you're talking about taking offline from the power sector 50% or so of current installed renewable capacity. And so blue hydrogen does provide an opportunity to scale hydrogen much faster, and you can take better advantage of the existing infrastructure. So I think that's absolutely an important piece of the path forward.
Thank you, Randy. Fiona, how much work is going on to convert hydrogen to liquid fuel suitable for air and road transport? Can you comment on that?
Yes. Well, I'd say there's a lot of work. Basically, we're at a new frontier with hydrogen, and there is a huge amount of work going on through our, if I can comment on Australia, through our research institutions, through projects, pilots, demonstrations, using both traditional technology and new technology. At this stage, I probably couldn't point to anything in particular, because the main challenge is more about the economics. In most cases, it's the economics as opposed to the technology, but the technology can find ways of making the economics better and can also surprise us with new innovations. So I'd have to say it's sort of a bit of a cop-out answer, I'm afraid, but there's a lot of work. There's a lot of work going on. The question is how does any one player make that work something which is useful at scale and can be recognised as a meaningful path for how we can get hydrogen to be the fuel carrier of the future, energy carrier.
Thank you, Fiona. Thank you. I've got an interesting question about can the logistics and shipping or transportation storage infrastructure for LNG be easily adapted or directly used for hydrogen as well? I think we touched on it previously. It seems that I think there's a view that there's a lot of money already spent. It doesn't make sense to put in a lot more money. Is there any other panelists who want to share their views on this as well? Can I ask Randy maybe?
There are physical properties of hydrogen, as Fiona referred to, that are different than natural gas. And so I know, for instance, with pipelines, after you get to a certain percentage of blended hydrogen, you do start to have issues with the current technology, and you need a different sort of makeup of the metal in the pipeline. I couldn't comment on the actual, the LNG facilities, but there are different physical characteristics that need to be accounted for.
Right, Kenneth, do you see LNG as a sustainable solution in the long term, given hydrogen and all the other competing fuels that are coming online?
Yeah, definitely. I think for LNG, the journey has only just started, right? It is still a young market. It is comparatively a cleaner fuel, especially if you look at the marine fuel mix. It is one of the pathways to a carbon-free sort of market. Of course, then you would have ammonia and hydrogen being on the next step. So in terms of a future fuel mix, LNG definitely is and it should be very key over the next couple of decades. I guess there are a couple of key opportunities for further growth and for LNG to actually compete better against existing less clean fuels such as oil and coal, as well as the cleaner fuels like hydrogen, as well as the renewables. A couple of changes or tweaks need to be made to how the industry functions. And of course, one of the biggest debates right now is on pricing, on LNG pricing, because LNG is one of the rare markets we know that is a liquidly traded commodity whose long-term contracts are still largely based off another liquidly traded commodity, which is oil. So I think there could be potential for change here, and we do see gradual acceptance for the market to shift perhaps closer towards market-based pricing, which is LNG pricing for longer-term contracts. But I personally don't think it's going to be an overnight shift. It could be a shift that takes several years or at least a couple of years. Another key change that needs to take place would be a transformation of LNG into a more competitive and transparent market. And one of the key things for kind of market transparency would be on the derivative space, where there could be greater risk management options, greater options for benchmarks for LNG in Europe and in Asia itself.
Thank you, Kenneth. Kenneth, I'm going to ask the very last question, and I'm going to ask that question to Jean of the IEA. The Singapore International Energy Week theme is creating our low carbon energy future together. Can I have some of your thoughts of this theme?
Sure. Well, I think that the theme is particularly relevant in the current situation that we're experiencing with those massive changes and impacts of the current crisis. I think that there's a growing recognition that was expressed by all panelists of the impact of the energy consumption and patterns, and that the need for energy transition and low carbon future. I think that in the current situation with those all the recovery plans and stimulus packages have been issued by the different jurisdictions and countries throughout the world to battle the impact of the COVID crisis, this is certainly an important part to take into consideration, how to shape the future in terms of sustainable energy development, not only economic recovery, but sustainable recovery.
Thank you very much, John. And to my panelists, Fiona, Kenneth, Randy, and John again, thank you very much. Back to you, Kylie.
Thank you, Mr. Mahawar, Mr. Dubreuil, Mr. Fu, Dr. Simon, and Mr. Bell for the insightful and well-rounded discussion. And thank you to our partner, S&P Global Platts. With that, we have come to the end of today's discussion. A recording of this session and the presentation slides will be made available on the SIEW website. We would also love to hear your thoughts and experience on the webinar. This can be done through the feedback form, which you can see on your screen. We look forward to welcoming you at SIEW 2020 for discussions on this year's theme, Creating Our Low Carbon Energy Future Together, taking place from the 26th to 30th of October. On behalf of the Energy Market Authority, thank you for joining us today.